Hey guys, I hope you guys are doing good today. Imagine a company got collected 70,000 crores in financial year of 25 and its net profit is just 1,185 crores. That is just 2% left on the table. Where did the rest go? This is ICICI Prudential Life Insurance, India's third largest private life insurer. The stock, it got crashed from 52-week high of 707 rupees to 485 rupees. It is down at 31%. Today, we do a deep, honest review on this stock. We will be talking about how exactly they make money, how is the demand of life insurance companies, fundamentals, valuations, and my honest review about this stock. Please do stick till the end of this video so that you will get my honest reviews and opinions about this stock. Without wasting time, we can get into the videos. Before that, if you're new to my channel, please do hit a like button and please do subscribe my channel. Let's go. Hey guys. How does the life insurance business actually work? Insurance is not a normal manufacturing or retail business. The accounting looks different. Here is the simple flow. A customers pay a premium. This is booked as a sales. They got 63,000 crores in financial year of 26. The company invests almost all of the premiums into bonds, equity, and the government securities. Company, the payouts, claims, commissions, and the expenses. So what is left after the actuarial reserving? That is profit. There is a key point. The liabilities will always looks high for an insurer. Why? Because the every rupee of premium collected, it creates the future obligations. I mean to say a policy payout. ICICI Prudential Life Insurance, when you look at the other liabilities in the screener, you should able to see something like 3,03,000 crores. That is 95% of the total balance sheet. This is actually normal and not a red flag for an insurance company. It is the nature of the business. The policyholder funds held in the trust. The real profit driver is not a sales. It is a metric called VNB, a value of new business. VNB is equal to a present value of future profits from a new policy sold this year. When you look at the financial year of 26 of VNB, it is 2,629 crores. It is up 10.9% year on year. At a VNB margin of 24.7%, it is up from 22.8% in financial year of 25. A second key metric is called embedded value. It is a true intrinsic net worth of insurer. In financial year of 26, the embedded value is 52,989 crores. It is up 10.5% year on year. When you look at the return on embedded value, which is 11.9%, this has been falling. 17.4% in financial year of 23, 14.1% in financial year of 24, 13.1% in financial year of 25, and 11.9% in financial year of 26. That is one final takeaway. Don't judge the insurance company is just like a manufacturing or retail business. We need to watch VNB, VNB margin, embedded value, and RoEV, not just a sales and a net profit. Let's understand how is the demand. The India's insurance penetration is actually falling and it is not rising. When you look at the overall penetration, it is 4.2% in financial year of 22, which is peak, 3.7% in financial year of 25, and it is a third straight year of decline. The life insurance penetration is 2.8%, which is 2.7% of the GDP. The global average is 7.3%. India is less than half of that. This sounds bad, but for a value investors, this is actually the opportunity. The massive underpenetration is equal to a long runway of growth for next 2 decades. When you look at from the government's angle, insurance for all by 2040 vision plus 100% FDI allowed plus Bima Sugam digital marketplace. On top of that, the GSTs on individual life premiums is removed, 0% GST reforms in September 2025. This is already showing the results. The ICICI Prudential Life Insurance, the specific demand signals are the retail protection APE, it grew 32.3% year on year. When you look at the H2 financial year of 2026, we see it is like 50.9% of the growth. This is the highest margin segment and it is growing fastest. But the overall APE, I mean the new business volumes, it grew just 2.2% year on year. This is actually a weak signal. The number of policies sold, it grew 11.7% year on year. It is decent, but the ticket size plus mix, it is completely shrinking. The 13-month persistency, basically the customers are renewing, it fell from 81.1% to 84.5%. It is a genuine concern. It means most customers are lapsing yearly. Finally, the long-term industry tailwind is strong. A company-specific near-term demand, I mean the APE growth, it is somewhat soft. Let's understand the fundamentals. We need to do a deep dive for this company. Growth, is it genuine or manipulated? Let's understand. When you look at the net profit, it is 8 850 crores in financial year of 24, and in financial year of 25, which is 1185 crores. In financial year of 26, it is 1608 crores. The growth is 35.6% year on year in financial year of 26. But the management itself admits the profit growth was mainly due to an high investments income from the shareholders' funds. When you look at the sales and the premium, it actually fell. In financial year of 24, they had like 89,683 crores. In 25, they got like 70,778 crores. In financial year of 26, it is just 63,357 crores. Okay, the red flag check we need to do. The profit is rising while the top line premium is falling for straight 2 years. The profit is coming from investment gains and the cost efficiencies. It is not a core underwriting growth. It is a worth watching and not manipulation as well, but not a quality growth either. ROE and ROCE. The ROE is 12.6% as per the screener. The my own calculation from the raw numbers, it is giving like 11.8% for financial year of 26. It is up from 9.9% in financial year of 25. The ROCE is 10.1%. It is an average for capital light insurer, but the below high quality compounder, which is like 18 to 20% plus club. For insurer, the RoEV, it is 11.9%. It matters more than ROE, and the number is declining and it is not even improving. That is a real quality signal. Okay, let's understand the cash flow. The golden rule check. The operating cash flow, it should be positive. The investing cash flow should be negative, which is like deploying a cash to grow. This particular company, it is following this golden rule in 3 straight years. When you look at the numbers, in financial year of 24, they had like minus 7,315 crores. In 25, which is like minus 9,413 crores. In financial year of 26, which is minus 5,355 crores. The investing cash flow is positive. They got like plus 7,571 crores in financial year of 26. It is opposite of what a healthy growing company. So let's understand why this is happening. The insurance companies classifies the investment purchases, basically the bonds, equities, which they bought with the premium money, which is completely under operating activity and not investing. So here, the negative operating cash flow does not mean the core business is bleeding cash. It reflects a book reclassification. It is tied to investment portfolio movement. But this is why exactly we need to check the internet and the actuarial disclosure. We should not blindly trust the CFOs, the line of insurers. On embedded values and the solvency basis, the company, it remains healthy. Let's check the balance sheet. I mean, we need to check the debt positions. When you look at the debt, they got 2,595 crores, the subordinated debt, which is used to shore up solvency capital. It is common for insurers. The debt to equity is 0.19. It is low and healthy. When you look at the debt trend from financial year of 21 to financial year of 24, they got 1,200 crores. It is jumped to 2,600 crores in financial year of 25, and it was stable at 2,595 crores in financial year of 26. The debt has not reduced. It has got stabilized after doubling. This is something a mild watch item and not a red flag as well. Since the debt to equity, it remains low in certain absolute terms. Okay, let's check the solvency. It is an insurance specific safety to check. The solvency ratio is 227.3% as of March 2026 versus the regulatory minimum of 150%. This is the single most important safety metric for an insurer. It is well above the floor. The claim settlement ratio is 99.3% with average turnaround is just 1.1 days for non-investigated claims. It is an excellent customer trust indicator. It has a 0 NPA since the inceptions on investments book. It is an high underwriting and the investments are completely disciplined. Okay, let's check the promoter integrity. The promoter is ICICI Bank majority along with the UK based the Prudential PLC. No major fraud, scam or SEBI enforcement actions associated with the company as of this analysis. Look at the ESG. It retains highest ranking in Indian life insurance industries as per the global and Indian ESG rating agencies. No pledge concerns. The promoter is a listed bank with a strong governance track record. Let's check the valuation. Are we paying the right amount or not? For an insurer, we should not use a plain PE the same way as the manufacturing companies. We use something called the price to EV. It is a primary lens. PE and the PE, it is a secondary sanity checks. I mean, price to book values and normal PE. When you look at the stock PE, it is like 43.8x versus the industry PE is 68.6x. The stock, it trades at the discount to a sector average on a pure PE basis. The price to book value is 5.16 versus the industry price to book value is 7.66. It is again the discount to the industry. Now let's understand P by EV. It is 1.5 in financial year of 26. The market cap is 70,000 crores and the embedded value is 52,989 crores. When you divide these two, you will get the ratio 1.5x. Historically, this stock, it trades at 2x plus EV as per today. Today, it is below its own historical average. Look at the PEG ratio, which is 1.72. Anything above 1, it is suggesting the price is slightly ahead of near-term growth. The ideal PEG is under 1. Why the discount to peers like HDFC Life? The market is pricing in the falling RoEV, which is like 11.9% versus HDFC Life is 17%. A weak APE growth, it is 2.2% versus the HDFC Life has the stronger growth. There is a persistency decline as well, which is 84.5%. The fair logic value at 1.5x of EV with the fundamentally improving VNB margin is 24.7%. The stock is optically cheap versus its own 5 years history, but cheap for a reason. A re-rating needs for APE growth, which needs to be back up to 10%. A persistency stabilizing and a RoEV recovering towards 11%. When you look at the margin of safety for this stock is partial. Valuations offers certain cushion, but the business quality trends like RoEV and the persistency is completely deteriorating. This is my opinion. What exactly ICICI Prudential Life Insurance is doing? There is an improving VNB margin, disciplined solvency, which is 227%, strong claim settlements, a shifting mix towards high margin retail protection, zero NPA and low leverage. What exactly concerns me? There is a following RoEV straight 4 years, weak APE versus the top line growth, declining persistency and the profit growth increasingly reliant on investment income rather than the core insurance underwriting growth. The valuations is cheaper than the history and the cheaper than the sector. But it is cheap because the growth engine has slowed, not because of the market is irrationally pushing a great business. This is business I understand and the respects for its governance and the balance sheet safety. But the growth quality signal, it needs to improve before I get more constructive. My honest opinion is I may consider a staggered exposure, basically weekly, bi-weekly or monthly. I will be investing on this stock purely as a long-term bet on India's insurance under-penetrating story. It is not a lump sum entry at the current levels. I will be watching for next 2 quarters for AP growth recovery and the persistency improvements before increasing the convictions. This is not a buy or sell recommendations. Always do your own research or consult a better advisor. I am not a SEBI registered advisor. This is my pure analysis and I'm just sharing my investment strategy. If you found this particular video is helpful for you, please do hit a like button. Please do subscribe my channel. Thank you so much. I will be seeing you on the another video. Thank you so much. Bye-bye.